Hi everyone, my name is Sam DeCourt and welcome to our August monthly video update. Joining us today is Michelle Lopez, Head of Australasian Equities, joining us from Sydney, and Mike Taylor, Chief Investment Officer, joining us from Auckland today, Mike. Hi Mike, hi Michelle.
Hi Sam.
So we'll get straight into it. The big news this week in New Zealand, Mike, has been the cutting of the official cash rate in New Zealand. You've obviously been very vocal on the topic, calling for it to be cut faster and harder. Not good for term deposit holders, but good for the New Zealand economy. How are you feeling?
I won't use the phrase too late, but I would say I guess it's better late than never. The New Zealand economy has been really struggling for the last 2 years, Sam. So yes, I've been quite vocal in making a call for interest rates to be cut and cut aggressively. We're down to 3% now, but I guess it was the tone of the message from the Reserve Bank, which was that they're more dovish than what the market was expecting. So they are sort of hinting in their forward track that the OCR might go down to 2.5%, which of course I think if it did go to 2.5%, would be quite stimulatory for the New Zealand economy. We're still only around about where sort of a neutral rate might be, sort of 3 to 3.5. So I'm looking forward to seeing rates back at 2.5 and a decent recovery in the New Zealand economy, which if it starts this year, hopefully gathers some steam in 2026.
Yeah. And Michelle, a lot of the companies that you're investing in Australia, they have global sales, global operations, which include New Zealand. Are you hearing anything from your investments about conditions in New Zealand getting better already, or how are you feeling?
Well, in fact, we're, as you would know, in the thick of reporting season, and a number of our retail companies have actually come out with very strong results out of New Zealand. I would probably just say, though, these are more the not incumbents in the market over there. It's more disruptors, but we're actually seeing some really positive green shoots from our retailers in particular, posting anywhere up to 25% sales growth out of their New Zealand operations. So I think it is turning. That inflection point is in. Having said that, it is still pretty early days.
So on the topic of reporting season, this is really a couple of weeks, the busiest couple of weeks of the year really for your team over in Sydney, right? Where Australian companies are reporting their full year results. How's it going so far a couple of days in?
Well, yes, I think the larger cap side of the market tends to report first, and we've seen some spectacular moves in that space, and sadly to the downside rather than to the upside. So think about your market darlings here, such as CSL and CBA and James Hardie, and they've had some pretty disappointing results coming out. We don't actively invest in that part of the market. We are more in the mid cap and small cap part, as you would know. Mid caps on average have reported very solid results, and they're pulling out some great trading updates as well. And small caps and micro, we're really just getting started with those, and next week's going to be pretty solid in that respect from the smaller end of the market.
Any themes, Michelle, that are starting to play out?
Yeah, look, I think there's a few trends I'd probably call out at this point. Firstly is the resilience of the consumer. So we've had a number of our retailers report. As I mentioned, New Zealand's been a bit of a bright spot, but more generally, they're posting stronger results than we had expected. And importantly, very good trading outlooks over the last 6 weeks since financial year end as well. So we're seeing that the consumer really being stimulated, and maybe that comes back to the fact that we've had our second rate cut. So we received that last week, and we're starting to see also the property sector really pick up. And we've been in a pretty depressed market from a property and a REIT perspective. We've got some very deep valuations to asset values here, as probably in New Zealand as well. But we're starting to see that part of the market move. And then finally, the other thing I'd probably call out is just valuations, particularly in the mid cap space, is probably looking a little bit stretched. But having said that, the earnings have been upgrades. So again, just be mindful that valuation alone won't necessarily relate to sort of a pullback in markets.
Thanks, Michelle. So some positivity in our part of the world.
Yeah, let's see how next week goes.
Mike, back to you. So since early April, mid sort of April, markets have had a very strong run kind of across the board. What's sort of driving this, and what will continue to drive this potentially from here?
I think the first thing to cover off, though, Sam, is that markets from April were only really recovering to where they were at the start of the year. So, yes, it's rallied quite a bit from that sort of 20 to 25% sell-off. But if you strip that out, markets generally are only up about 5 to 10% for this year, depending on which market you're talking about. So a 5 or 10% gain for a calendar year, is actually not a lot. It's nothing to be stressed about or worried about. Should we be worrying about the market collapsing or being too expensive? So what's driven the rally back from the April sell-off? Well, of course, that sell-off was originated in the tariff uncertainty, and we've got a reasonable amount more certainty now of where tariffs are going. Ironically, they're kind of winding up very close to where they were in many cases, forecast at the beginning of April. But the market and consumers have kind of got used to that. It's kind of just noise now, and most trading partners with the US have nutted out a deal. And of course, the main positive thing, or what's driving the market really, is the AI spend and the AI capex that's coming through from the hyperscalers in the US, as well as from the AI generative businesses out there like OpenAI. They're spending a lot of money building out data centers, hiring people, and sort of deploying that. Not to mention, just about every firm these days is using AI in some way, shape, or form to try and improve the productivity and gain efficiencies within their business. And that is really what is driving the economy and the market today.
Yep, including Pi funds, obviously using AI a lot more than in the past for back office operations, all that sort of stuff.
Absolutely. Yeah.
All right, we'll wrap it up. Thanks for joining us, Michelle. We'll get back to your busy couple of weeks of reporting season. Thanks for joining us, Mike. And most importantly, thank you very much for watching. We'll see you next month.
Thank you.